In this episode, we'll look at Hong Kong family offices and their increasing focus on private lending, a warning from a Swiss asset manager on private credit default rates, and the outlook for the Middle East conflict and oil prices. Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundin's Investor Insights. Join us as we dissect the biggest and most interesting news on economies, financial markets, and central banks globally. Welcome to the show. Hello to our listeners and hello, Peter. How have you been this week? It's been quite an action-filled one.
Yeah, hi Mel. There's a lot going on. Of course, there's um, a lot of investor focus on what's going on in the Gulf and the
Mhm.
Middle East. We need to take decisions about what we trust the most, in what direction, how to manage the risk. So yeah, and that is the situations where the world simply brings a lot of activity to the desk as things happen. And otherwise, yeah, we are busy in many directions. But of course, the actual happenings take take a lot of attention, and we are very focused on how to manage and what to expect.
Mhm.
So yeah, how are you doing, Mel?
Peter, it's actually been productive on our side. We have just
Good.
released our first quarterly magazine for the year. So that's the China and ASEAN Quarterly. And we've
Yes.
gotten quite good feedback from our readers, our subscribers.
Yeah.
We did frame the magazine as taking the metaphor of the frowning horse manufactured in China from a few months back. It was quite a funny story that we took as a capturing what's confronting Asia at the moment. Of course, a lot of our production process happened before the US and Israel attacks in Iran and the rest of the Middle East. So we'll discuss more about that in our podcast as well as in our upcoming magazine. So a lot really that we're watching out for, and we'll talk about that more today. Let me go
Yeah.
first, Peter, to our first topic is it's about the view of Hong Kong family offices. So it's quite interesting. Hong Kong is trying to actively position itself as the home base of choice for family offices in Asia. And they're
Yeah.
making some progress on that. And actually, their central bank, a unit of their central bank, has released a study about covering 100 and so family offices based in Hong Kong. And the story that's emerged is growing attention among family offices regarding investments in the private markets. So, private equity, venture capital, and even on private credit. So, this captures the great need for diversification, not just away from the US, but away from traditional instruments, so to speak. And yeah, so private equity, about 77% of family offices in Hong Kong now hold some stakes in private equity and venture capital, although 91% still have equity. So that's really the mainstream choice.
Mm.
But there is growing attention. Now, more than half of them also hold some money in private credit. And
Mm.
even digital currencies, digital assets are growing in attention, although much lower than the rest of the, shall we say, real world assets. And yeah,
Mm.
there is clearly a search for diversification as well as high growth opportunities, high profit opportunities. And yeah, that really aligns with what we've observed, and mostly our recommendation to look towards the private markets for growth. Of course,
Mm.
as we always say, it has to be well considered. So you don't go just into any private sector
Mm.
player or privately owned company for funding. You have to be selective about it. You have to study them really well. And yeah, that is something that we'd like to see because there are greater risks in that space, but also a much higher potential for return if you bet on the right company or the right player. So that
Mm.
is an exciting space that we're monitoring in Hong Kong, potentially for the rest of Asia as well, because it is a vibrant market. There is a need for credit, especially for countries where the capital markets remain shallow for
Mm.
starting companies.
Mm.
So it is an interesting finding.
It is it's a fascinating development, and again, we can only encourage investors to not alone keep an eye on it, as I simply dive into it. Be spend time at least. We as we won't say it, you, just invest because invest without understanding the market is equal to lose money. Yeah, but and there are a lot of aspects in what you're raising there. Hong Kong is gaining ground again. They sort of after the Chinese took over the administration, sort of many Western players they left Hong Kong, and Hong Kong was a bit lost in. Also, then we had the COVID-19 and everything. It got a bit lost actually. There's an ongoing battle between Hong Kong and Singapore.
Yes.
And for some years now, Singapore sort of advanced the most. But I'll say the past 12 months, also what I observe when I'm in Hong Kong myself is business is growing, business is coming into Hong Kong,
Mm-hmm.
financial business in particular, as you mentioned. And they're fighting as we are talking about whatever, yeah. As it is also as a zero. You can go there, you pay zero in tax. You say it's pay 0% in capital gain tax. You as a you really have your income as a
For
foreigner
yourself.
yeah, for yourself and zero. You don't even have to live there. You just need to register. As a this, all things are done to. And I would say I've spoken with other people who also frequently visit Hong Kong. Sort of what we call the bus, as simply the bus in the in the town. Yeah, is is um, is sort of on the rise again. And
Mm-hmm.
we are also talking about if you want to go to a favorite restaurant you have, and we are back in a situation you might need to book 2 months ahead and so yeah. So it's as things are moving forward, yeah, for the
Bustling, yeah.
city. Yeah, it is, yeah. So it's fascinating to see Hong Kong again at a higher pace, and of course more and more investors going more and more into alternative investments.
Mm-hmm.
The wealth is growing. Family offices are growing. What they have under management is growing. But as we've called so many times here past years for more IPOs in the stock market, and as the IPOs are still limited, the money needs to go somewhere else, and they go into what we call the private market, yeah, the non-listed market, and this is what's happening also in Hong Kong. And as we are talking about Asia, we do that every week, of course, but still, again, a study from IMF came out. I actually believe it's pretty late. It came out the other day, showing and they just recalculating how um, how the global economies or the yeah economies around the globe are in size when we take adjust for purchasing power, as the PPP, and that now once more confirm that what the IMF is concluding is that the economy, as Asia as overall, is simply growing so much faster than the rest of the world that the change of being the economic dominant is
Mm-hmm.
happening much faster than uh, people are believing. Um, and based on the purchasing power adjustment, then Asia now represents 49% of the global economy. 49%. We've long known and seen that Asia is the biggest economic region in the world, but now just just around the corner, Asia is representing more than half of
Mm-hmm.
the economy of the world. And this also speaks for its logic that the families offices that are in Hong Kong, they go across Asia into different companies, private equity, whatever, alternative investments, to source investment opportunities. again, it's just another encouragement for investors to dive into to this field and area. Yeah, so that's
Asia is really
yeah,
raking
yeah,
in the growth, and yeah, it makes sense
it's
to be here as far as investments are concerned.
it is it's a complete different beat, and this we can only repeat. Good. Anyway,
As we talk about private markets, Peter, there is an interesting view, maybe a bit different from what we just discussed, coming from Partners Group regarding private credit and potential higher default rates. What do we think about that, Peter?
truly interesting because these guys, based in Switzerland, the Partners Group, they actually know something about alternative investments. Let's be honest, they are slightly bigger than we are, Mel. Let's be honest. They, the revenue last year, the fee income was in 2025 was 2.5 billion Swiss franc. It's like 3 billion US dollar, yeah, in
Yeah.
fee revenues from managing money, and also from some other revenue streams. But anyway, it's predominantly a asset manager, not sort of in if we look into the headlines, so sort of not that well known. It's not like Goldman Sachs or whatever, yeah. But
Mm-hmm.
they actually know a lot about what they're doing. People who are um, sort of talking, giving some insight, and if they're good, of course we listen to that, and we would also like to refer it. And now we are happy for alternative investments along with capital. We argue it is 30% of the portfolio, and that we've
Mm-hmm.
done for a long time. We were very happy when BlackRock came out and said last year this is also their new
Yes.
approach. And then we were talking about one of the absolute biggest asset managers in the world
Mm-hmm.
recommended this to whoever investors you are as default. So these things are interesting, and now we had talked about the exactly the private credit part of the alternative investments, and then this partner group interview because it is to find today in Financial Times, and I actually think it is just released for we were talking about 4 or 5 hours ago, so it is
Yes.
absolutely crisp. But the key is when we look into private credit, and that is actually lending
Mm-hmm.
to private companies. Yeah, they're simply taking over part of a typical banking role. And private credit has been let's say it's been fairly hot the past 18 to 24 months, maybe a bit too hot. Anyway, we
Mm-hmm.
like it as a alternative fixed income investment, and we would argue it fits into as a really truly a lot of portfolios. So it's
Yes.
worth for investors to look into, and they're good returns still. But it has been booming, and when credit is booming, then the quality is a risk. It gets a bit more lax, more money are lent out, and
Because it's fast.
that's been yeah. So the lending book starts to be not as fine as it
Mm-hmm.
used to be, and that's of course a problem. And there has been a problem in a couple of huge examples last year in US, and that has sort of shaken the private credit community a bit. And now Partner Group is saying that when they could see the default rate going up from 2.7 to 5% within a pretty short time, as when we talk about 1 or 2 years.
Yes.
But when we read what is, after all, also part of what they're saying, it is when we focus on a software company as a private credit funds with a lot of software company exposure.
Mm-hmm.
That is where they see this, and this is another reminder that when
Yeah.
we look into private credit funds, it's so important to look in what are they active in. As a, some are simply solely active in maybe airline financing or aircraft financing
Mm-hmm.
or parts of aircraft. So it can be everything. Yeah. The Harley Davidson was a fantastic example on how a part of the company was financed by private credit.
Mm-hmm.
They can be very specialized. So when investors are looking into private credit funds, they truly need to understand what these funds are doing, because they can be in all directions. And it means some segments are doing good
Yes.
and some are doing bad. And the key, and that is another takeaway from this interview that is interesting, is why are software companies under pressure? This is from AI. And then you say, hey, listen, AI and software, that is IT. That's the
Yeah.
same. No, it's not. The key is that a lot of software companies, what they're producing, can in
Mm-hmm.
the future be produced by AI, basically. And that is the key. And this is where investors are now a bit afraid, saying some of these software companies will default. And that,
Mm-hmm.
of course, will hurt some private credit funds. So a lot of things there to take away. Interesting views. Again, we like private credit, but we need to know what's going on in the fund, and it's
Yeah.
not all. Yeah, it's simply not everything that works. Going back to your friends in the Hong Kong family office, um, there are truckloads of opportunities still in that direction,
Mm-hmm.
and we still see this area actually is still growing also in Asia in particular. Yeah.
I
So
think a lot of due diligence has to be done. Maybe
yeah,
in some haste to get on the AI bandwagon, you become trigger happy with who you lend to. So it's really boiling down to studying closely and
yeah,
scrutinizing what exactly are the products and services that that particular privately owned company is doing or producing before
yeah,
you consider if they're worthy of private credit lines to begin with. And yeah, that is also a lot of that will dictate about their ability to pay down the road.
exactly. So just another reminder: when we invest, we need to know what we do. That's always good, yeah. But still, we like the asset class, but we're fully
Mm,
aware of
of the risks.
it's not only sunshine. Let's put it this way.
Yes.
Good.
Speaking of perhaps the biggest disruptor of the month, of course, we need to touch base with the Middle East conflict and how it has evolved over the past week. Of course, the most upfront effect is through the oil price channels. It has dramatically raised pump prices over the past few days. And now there are even fears or early concerns about a US or maybe even a global recession discussions on the table. I don't
Mhm.
see that as a risk just yet, but of course, it is something that should be monitored and talked about.
Oh yeah, this is the absolute dominant focus right now. Of course, we need to take it extremely serious and be try to come up with well thought sort of views and advice actually on this situation. But what are sort of what is the household reaction in Southeast Asia? Sort of out of the door, Mel, what do people say?
Actually, here in Southeast Asia, we don't really have much to do because we are importing most, if not all,
Mm,
of our oil supply. So
mm,
the response here has been on the demand side. So Philippines, Thailand, Vietnam, they've resorted to work from home schemes. In the Philippine government, offices have shifted to 4-day work weeks, if only to reduce fuel demand and
mm,
hopefully keep prices down. There's even regulation on the temperature setting of air conditioning units, just so you
mm,
ease up on the power and elevator usage as well. In Thailand,
mm.
they're exploring biofuel blends as an alternative to crude oil. And in Vietnam, they are they have already paused tariffs on oil on imported oil, and that's also on the table here in the Philippines. Although, of course, the concern is revenues. We need more state revenues to keep the deficit low, and
Mm.
ultimately, the concern is, of course, we want to reduce oil demand in the short term, but ultimately that will also slow down economic activity. So we don't want that. It's only a short-term band-aid solution, hopefully. But as
Mm.
long as trade is disrupted, flows of oil shipments from the Middle East to the rest of the world remain blocked or limited, this will be an issue. Although the Asian Development Bank's chief economist has said that, well, at least per Trump's 1 month timeline, a 1 month disruption should only have a minimal or modest decline in overall GDP for emerging Asia. Of course, that is still sizable given how fast these economies could grow if they're working or operating in full potential. So the impact is 1 percentage point is the estimate, but of course, that's not really how it feels when you're the typical consumer who has to
Mm.
now adjust the budget to accommodate higher oil prices.
There's no doubt that Asia, Southeast Asia is yeah, is dependent on
Yes.
energy, on the oil import, and it's sensitive to any price increase. Investors should also take the price on liquid gas
Mm-hmm.
into consideration when we talk about Southeast Asia energy demand, because liquid gas is sort of for the power production also.
Mm-hmm.
Qatar has been pretty straightforward, saying right now it is not because they're increasing the prices, simply the shortage of
Supply.
access to liquid gas
Mm-hmm.
that is driving, and it will be painful for some time. That is a risk. So yeah, that is an actual sort of squeeze. Let's be honest on that. And if we look in a bit to how we see the situation in the Gulf, in the Middle East, um, we actually consider the U.S. And Israel military campaign as successful in the way of what they have been targeting. Understood in the way as they have really eliminated a lot of military targets. And also, if we look at Iran's capability to hit back, so to say,
Mm-hmm.
if we look into the first week of the military campaign, meaning basically last week, during that week, the number of missiles and drones that Iran fired fell with 90%, as from the Saturday when it began, and actually to the Friday, and so yeah, so less than a week. The attacks out of Iran fell with 90%. So there's a lot, as a how to say, a lot has been uh, done
Fired.
from, yeah, from the US and Israel side. And also, as soon as it became obvious that Iran was maybe about to try to place some sea mines, the whole armada of 24 sea mine ships, vessels
Mm-hmm.
in Iran was damaged and sunk within 24 hours. So as the US military machine is very efficient as we know it. Um, but it has left Iran, as we see it today, as what we would call as what they can master is advanced terrorism attack. So they do have missiles, they do have drones, and they can cause havoc, and they do actually hit stuff here and there in the whole region. That
Mm-hmm.
is obvious. We see that. And the worst thing is they still control or block the Strait of Hormuz, and
Yes.
that is a duty now. That is a duty now for the US to get it opened. And we could say, how long time do they have? As you refer to that the Asian Development Bank, they say, okay, of course, as when we're looking at oil price above 100 again, it
Mm-hmm.
is painful. It is
Yes.
painful for the economies, for the consumers, for everybody. But it's not so that the world will crash because we have a squeeze for a couple of weeks.
Mm-hmm.
We see the discussion, we see some headline discussion about what will central banks do. Yes, as the central banks are not born yesterday. They know higher oil prices equal to high inflation. Yes, but they don't hike the rates due to that outlook. It's not how central bank works. On the contrary, what they do on these in these situations is to secure that there is liquidity enough in the system. So the financial system will be flushed with liquidity, um, and that is what the central banks are typically securing, meaning the short-term rates are actually going down, if anything. Um, so that is also to see how do we see it? Do we see it dramatically? Yes, it is very dramatic, but it is this is not tilting the world and it's not crashing the world. But of course, the street homes needs to be open. And right now, what we have seen of comments and analysis from the admiral who's in charge of the whole combat um, force in the region,
Mm-hmm.
U.S. admiral, he has several times stated that they consider it too dangerous to go into the Strait of Hormuz right now. But if the U.S. President or the U.S. Government commands them to do so, they have plans about how to work around it. But it of course means that all of a sudden there will be it will be a battle, and it also means many more soldiers will die. And this is, of course, these casualties that US will try to avoid. That is fully understandable. So it's where we are now. US cannot leave it as it is. Last time we talked about it would be a disaster if US just thought that Iran would be sort of mushroom with democracy. We've seen the contrary, that another dictator is in the seat,
Yes.
and to walk away from the situation in the Strait of Hormuz now as a blocked, that is no go. Yeah, it's very much as the next step in as we see it in evaluating the risks are the likelihood that US or US plus allies can crack the situation in the Strait of Hormuz and get open so ships can come in and out. We know how difficult it is uh, to to um, to control drones, to see them.
Mm-hmm.
We own a part of a defense company, and we have a defense fund that invests into technologies to work against drones. So yes, we do have a lot of insights about how difficult it is, but still, it is a more limited area
Yes.
to control than
Mm-hmm.
to sort of protect the whole Middle East region. That is an advantage in itself. There are different ways to also to have a smaller area under control also from drone attacks. We have as our main primary scenario is now, as we boil it down, is we see a solution will be opened up. So the US and its allies can come into the Strait of Hormuz and try to protect it. It might not be as nice as people would like, but we trust this is the most as this is the primary scenario actually.
Mm-hmm.
It also means that we have the view that the oil price will come down again within a foreseeable time. We can also detect, and that we can directly from our contacts, that the business life in the Middle East is returning
Mm-hmm.
and trying to simply come back on foot. The last week was, of course, trying to figure out how heavy is the situation. Still, now there's a lot of sort of new organized working from home there as well,
Yes.
simply to avoid people maybe also being too much outside and whatever. Yeah,
Mm-hmm. To be
but
safe.
yeah, we do see a business life in the financial business also coming more back to normal life. So yes, the next step is to focus on hormones, and we have the main trust. It will actually settle. Of course, we can be badly wrong. We will time show, um, but this is how we see it right now, and meaning we actually sort of funny enough we are again maybe more positive than the world and
Mm-hmm.
also than the market. We have seen investors, we have been involved in it, investors who for a long time have been too overweighted, particularly US stocks and European stocks, using the fluctuations right now actually to rebalance and move a bit out there going into to Southeast Asia and Asia in general. So this is what we see here.
As far as our global outlook, Peter, of course, this conflict in the Middle East is an unwanted negative event as far as global markets are concerned, but we
Sure.
are navigating the way forward. And with our primary scenario, we do see disruptions, though likely limited if indeed that the conflict is resolved, and most importantly, the Strait of Hormuz is reopened for trade flows, especially oil, can return. And yeah, we do also see that this could be an opening for investors to reorganize, reassess,
Mhm.
recalibrate their portfolios towards uh, more high growth areas, including
Okay.
Southeast Asia, especially now that Middle East is in this scenario.
And so we do still see the sunshine. We know households around the world right now can be squeezed a bit, yeah, for sure.
Mhm.
But on the other side, if the world had been really nervous and really vulnerable, then also US and European stock markets would have been down with 15% now. And it's not, it's actually holding fantastic. It's holding much better than we have believed
Mhm.
from like more than 1 week ago. But anyway, so we actually see the world as still pretty solid, and this is one of the main issues why we say okay, we actually keep sort of most positions as they are. We can wear as a move a bit more to Southeast Asia, to Asia, but that is not to reduce risk. That is actually to stay via overweight risk still. Yeah. So this
Mhm.
is the outlook still from our side, um, and we will
A
see.
lot more to watch out for, Peter.
Sure.
So thank you, Peter, and thank you to our listeners for tuning in.
Yeah. Thank you. Well, it was yeah good, and also thank you to listeners.
Thanks for tuning in. We'll be on the lookout for market developments worth watching. Catch the next episode of Sound Economies, Mel and Peter on the global financial markets, available on our website and on Spotify. Here at Longines Capital, we've spent over a decade building a strong track record with our full suite of services and high performing funds. Now we're setting our sights on something even bigger, an IPO in November 2027. It's been a long time coming, and we are ready for the journey. Join us in our next big step. Visit our website to learn more.